news. First and foremost, if you are a daily viewer of the live show or the recorded session, thank you very much. We now routinely get over 1,500 folks enjoying the daily financial news. That is quite an accomplishment, and I want to thank each and every one of you. Again, it makes it worth my time to do the 60 minutes, kind of take notes and just have, kind of share with you what I think is going on for the day. As we head into the middle of January and the rest of 2021, I think a lot of dominoes are at least set up to fall, as we have been talking about for months. And let's talk about them here. First and foremost, got a text from my mortgage broker. Actually, you know him as Matt, the mortgage guy. I think I talked to him on Wednesdays. Sent me a note or text yesterday saying rates up again. He's joking with me saying stop calling for it. He wants to help more and more people get mortgages and refis and things of that nature. But folks, the 10-year note, I told you about this on the 1st or 2nd of January, is the one thing that is, what if I had one variable to track, that would be it. And it's gone from 0.91 to 1.16 this morning. That doesn't sound like a lot, but that's a 24% move. And that is impacting mortgage rates. That is essentially, folks, a Fed rate increase. If you've been watching the Fed or remember what they've done in the past, what do? They move by quarter points. We have essentially seen a Fed tightening in the 10-year Treasury in 10 days. Seriously, that's essentially what has happened. And that's going to impact mortgage rates. Again, that's the second day in a row, or 2 days out of 10 where the mortgage rates moved up an eighth. And again, I got that from Matt, the mortgage guy. So if you're on the cusp of getting a mortgage rate lock, might be the time. Again, I don't think an eighth or now a quarter total move in really impacts real estate all that much at the edges. But folks, I've been talking about the trend, and the trend reversed January 6th. So we need to watch this because this is going to be impactful for investors. Again, another thing I got, if you're one of my students, I'd love to hear from you in the next day or so in comments below. Have you seen inventory spike in your area? Now, spike is a dangerous word. Let's just say is inventory up 20% since, say, Christmas, or maybe since the 15th of December. Is inventory up 20% in your market? If you're one of my students, I tell you to focus, get a touch criteria, and let me know if it is up. And I ask this because I got two yesterday evening, actually during the college football playoff game, that they're seeing inventory rise in their markets. Now, these are Midwest markets. I don't know if it's weather related or whatnot, but given I expect inventory across the country to go up at least 50% by April, this would surprise me if it's going up already. So again, we got to watch this. And again, I think it's good news for you and I. You and I want to buy investment houses, right? I did 250 offers last year and got nothing. More inventory means more options, meaning more quality differences, meaning deals are out there. But we must thread the needle on price, interest rate, terms, all of that. So keep doing your homework, keep focused. If you're one of my students, you know what I mean. So watch that. The other thing to realize is multifamily is in some trouble. Because if you don't know, multifamily trades on a cap rate. Cap rate essentially is, a risk-based return of 4.5–5% in many markets. There's talk of the 10-year note, that metric I talk about as being the most important. Now, I don't believe this, but it was said this morning on CNBC that the 10-year note could hit 3% by the end of the year. That's interesting. Would you take a 10-year treasury at 3% or some multifamily building with all the risk at 4.5%? And oh, by the way, the tax changes that might be coming to multifamily. I think the cap rates are going to expand. It's going to make it harder to refi. It's going to make it harder to purchase. Prices are going to come down. But again, single family is what we are talking about. Grant Cardone did a session yesterday about starting small. I listened to about half of it. It is very interesting to see the bigger is better guy telling everybody they can go buy a house, go buy an investment house, go buy 1 to 4. He was very focused on residential. And that is because I think he is seeing in his portfolio rent collection issues. I think he is seeing cap rate expansion. And of course, let's not forget he's trying to sell stuff. If he's no longer taking non-accredited investors, he's got to sell them something. So he's probably selling them a real estate course or something. Who knows? But this is all stuff that's going around that I watch every day, and the dominoes are setting up. So please, again, if you're one of my students, let me know, is inventory up or down, maybe since the middle of December, because I think it is coming. What else do I got for you? So first and foremost, there's a lot of talk about bubbles these days. I think it's fair to say that maybe one of the areas that could be the biggest bubble is EV or electric vehicles. There seems to be some very high valuations. A company called NIO up 1,600% in a year or since its IPO. I think that's a Chinese-based EV company. Obviously, Tesla is up 750%. It's going to be interesting. Competition is coming. For example, in Europe, Tesla is no longer the number one EV seller. It's now BMW. Probably makes sense, right? BMW is a German company. It'll be interesting to see NIO compete with Tesla in China. And again, GM just announced a new offering for commercial vehicles. So again, EV is hot. EV is getting a lot of investments, and some will fail clearly, but some will be competition, and it'll be interesting to see what percentage Tesla keeps being the leader. So again, they did 500,000, just shy of 500,000 cars last year, and let's just say their valuation is stretched at 90 times cash flow last time I checked. I saw something yesterday, or actually I think it was this morning, that shook me. Cuomo, New York governor, Andrew Cuomo, I think his first name is Andrew. He said, and I'm quoting from memory, so it's probably off, but basically, New York must open or there will be nothing left. Wow, that's different. New York must open up or there will be nothing left. I've seen some numbers that New York is staring at a 14 or $15 billion shortfall. They've obviously seen a lot of exodus of the rich, as we've been talking about. The urban core has seen flight in single-family home ownership in other areas. New York is currently in a lot of pain. And it must be a lot of pain. It's probably pain that you and I don't see. Again, to have Andrew Cuomo come out and say that just seems total opposite of what I thought I was hearing from the New York governor. So again, I think we're closer to the end of this. This is, again, another sign of the light getting brighter. I see it as a good thing. I didn't expect it this early, but again, that's all good news. Again, I think 2021 is net very positive. Albertsons, again, we had some earnings announcements. Actually, they came out with a pre-announcement. They pre-announced beat on top and bottom, and they raised their guidance. So it's a classic beat and raise. Don't know if you saw this, but Walmart is now moving into fintech. Walmart is really expanding out of just being a retailer. Then we had 3 companies looking to raise capital via stock offerings, common stock offerings, again, very dilutive. Zoom Video looking to raise $1.5 billion. Wow. Lemonade, online insurance, going to sell 3 million shares, again, dilutive. And actually one in the REIT space, Realty Income. I didn't get a chance to look them up to see where their focus is. Is it office? Is it grocery stores? What it is? But they're looking to sell 10.5 million shares, again, raising capital. Talked about GM earlier. They are doing an electric vehicle. They have sold already 500 to FedEx. Again, this is a delivery vehicle. Think Amazon delivery vehicles, FedEx delivery vehicles. Again, the commercial space is very hot. What else? Again, just thinking about the year as we look out, I think we could have a total of $6 trillion in stimulus. by the end of Q1, certainly by the end of Q2. That's 12 or 13% of GDP. There's no wonder that people are now forecasting a 3% 10-year treasury. That's a lot. That's a ton. I think that, if the rate goes up to 3%, I think multifamily suffers. Again, why would you take a 4.5% cap apartment when you can get 3% kind of risk-free? I think inventory is going to rise. I think it rises 50% this year, so by the summer. I think demand, this is the wrinkle, right? So inventory rises. We go from record lows to kind of a even market, balanced market. What happens to demand? Historically speaking, and again, you can look this data up, when rates rise, it actually pulls forward demand. So we could have a very active spring selling season, but remember, these buyers are likely going to be owner occupants, and a lot of the inventory that's coming will not be owner occupant quality. That's going to be kind of the wrinkle, and that's why I think you and I as investors, right? If you're using the spreadsheet in my course, think all the A qualities will go owner occupant. All the B's maybe 50-50, but all the C's are going to be there for you and I to go buy, because owner occupants don't want to do a remodel, right? That's not what they're about. So it's going to be very interesting to watch. I do think we're going to get higher corporate taxes almost immediately. I think there could be an AMT version of taxes for corporations. I think there's going to be a lot of call for companies like Amazon. The fact that they pay zero is not okay. So I expect that. And I actually expect the dollar to strengthen. As weird as that sounds, I think as rates go up, it will strengthen the dollar, even with us printing a gargantuan amount of dollar, 12% of GDP. And then if we do that, if interest rates rise and the dividends stay in the 1.5 range, I wonder what that does to the market. Do we continue this early rotation out of growth, out of tech, out of the big 6 or the big 10 or whatever you want to call it, the ones with 90 times sales or whatever it is? Do we go and do the grand reopening, right? Do we go on cruises? Do we go on airplanes? Do we do hotels? Do we do Disneyland? Oh my God, Disneyland is still closed. It's amazing. So yeah, I think we do a lot of great things this year. But again, I think that 10-year treasury, we got to watch. The fact that somebody called 3% this year is, I don't know, I guess I'll say it, it's scary. I mean, my brain would not let me go that far. I think I called earlier in a video 2%. And 2% is a stretch, right? That's like 4 Fed tightenings. Go to 3%, that's like 8, 9 tightenings. Damn. All right, so again, remember, folks, real estate investing is going to be an exciting year. I think it's single family. I think it's residential. Go get that fixed rate debt. Even if you're getting something in the 3s, remember I started in the 6s. So just because you missed the window to get it in the 2s, it's not coming back. I don't think. Maybe it comes back for a minute, but I think we've reversed our downward trend. So just do your homework. Get ready. Do the math. Figure out the yield. Figure out average. And once you know average, it gets really, really easy. So we got 2 interviews today. Wow, 2.875. Good for you, Tamika. We got 2 interviews today. We got my 8 o'clock interview with that 9th grade dropout, high school dropout, Matt. And then we have the 9 o'clock with Omar. So I will be busy. Look for 6 videos because we usually do 3 each. 6 videos coming out. And I'm just loading my goals video now. I recorded it this morning. All the data is from Sunday. So that video probably is up already. But I did put that out there in case you want to see how I did last week. Take care. Bye-bye.